Okay, let's unpack this foundational truth of successful investing. Don't put all your eggs in one basket.
Right.
It sounds like an ancient proverb, something rooted in just simple, practical wisdom. But what if I told you that less than a century ago, this simple concept was mathematically isolated, rigorously tested, and codified into a Nobel Prize-winning science?
That's exactly the journey we're taking today.
Yeah.
We are driving deep into modern portfolio theory, or MPT, which is really the mathematical framework for diversification. It's also known more formally as mean variance analysis.
Yeah.
We basically took that common sense idea and gave us the mathematical rules for exactly how and why combining assets efficiently reduces risk.
So our mission for this deep dive is to take this huge stack of sources you provided, and they are rich with equations, definitions, historical context, and really deliver the critical insights.
Right.
We want you to understand not just the terminology of MPT, but how it forced every serious investor and money manager to stop viewing assets in isolation.
And start seeing them as, interactive parts of a greater whole.
Exactly.
A system. The central goal of MPT is deceptively simple: to maximize the expected return for a given level of risk. It's a structured approach to solving that fundamental trade-off every investor faces.
And here's where it gets really interesting, and this is the core nugget, right? The Markowitz insight.
This is it.
Before MPT, a portfolio manager might look at a stock and say that stock is risky. The risk was sort of intrinsic to the asset itself, but Harry Markowitz completely changed that.
He did. His crucial insight was that an asset's risk shouldn't be assessed on its own, but by how it interacts with and contributes to the portfolio's overall risk and return profile.
That shift in focus from individual asset risk to portfolio risk, that's everything, isn't it?
It's the entire game. And when MPT quantifies this risk, it specifically uses the variance of return, or its square root, the standard deviation.
And why variance? Was that just an arbitrary choice?
Not at all. It was chosen precisely because it's mathematically tractable when you're optimizing these huge complex combinations of assets. It's what allows for the constrained quadratic optimization you need to actually define the efficient set of portfolios.
So Markowitz introduces MPT in his seminal 1952 paper, Portfolio Selection, and it leads much later to his Nobel Prize.
Right.
But our sources point to a really interesting historical footnote. Was this concept truly born in 1952?
Not entirely, at least not in the conceptual sense. We can see that the mathematical idea of mean variance analysis actually showed up earlier.
When?
In a very obscure paper in 1940 by an Italian mathematician named Bruno Di Finetti.
And it wasn't even about stocks and bonds, was it?
No, not at all.
Yeah.
It was in the context of proportional reinsurance, basically. How insurance companies should structure their own risks to maximize their expected profit while minimizing their volatility.
So the same math applies.
It shows that the mathematical relationship Markowitz found is fundamental to managing financial uncertainty in any form. But Di Finetti's work it remained unknown to the English-speaking economic world until much later.
So Markowitz gets the credit.
He gets the credit because he built the comprehensive, applicable structure for investment, making it the bedrock of modern finance. It's a great example of how context and timing can matter just as much as the brilliance of the idea itself.
Okay, so let's move into the mechanics of it. If MPT is fundamentally a mathematical optimization model, we have to understand the inputs and the core assumptions that govern the whole equation. What's the behavioral bedrock this theory rests on?
MPT assumes investors are risk-averse. And this isn't just a casual observation, it's a necessary input for the model to even work.
Okay, so what does risk-averse mean in this context?
It assumes that if you have two portfolios that offer the exact same expected return, a rational investor will always choose the one with the lower volatility, the lower standard deviation.
And
Conversely, the only reason an investor would ever accept higher volatility is if they're being compensated with a proportionally higher expected return.
But wait a second, doesn't that assumption immediately get complicated by what we see in the real world?
How so?
Well, the rise of highly speculative assets, meme stocks, certain crypto assets, it often seems like the volatility itself is the attraction, not the deterrent. That chase for massive, rapid, outlier gains seems to contradict pure risk aversion.
It does, and that's one of the many points where MPT gets criticized, and we will definitely get to that.
Okay.
But for the model to function mathematically, it needs a consistent behavioral assumption. MPT sort of abstracts away those psychological drivers and just assumes the investor is purely rational, focusing only on that quantifiable trade-off between mean return and variance.
It's a simplifying assumption needed for the optimization to work.
Exactly.
So let's talk about the inputs then. We need to accurately measure the return of an individual asset, which the scientists call 3. It's defined as the total net return. Why the emphasis on net?
Because MPT is designed to be grounded in the economic reality of the investment. It has to reflect realistic net performance, including all costs and all income streams, not just theoretical price changes.
So the universal formula is pretty complex. It includes the change in market prices, plus distributions, which is singular, plus accrued interest, civilly dollars, and then it subtracts all the transaction costs for buying and selling.
Right. The Civi and Dale Civio.
So we're not just talking about broker commissions. We're talking about all the subtle drags on performance, like custodial fees or expense ratios in funds.
Absolutely. If you're optimizing for an efficient frontier, you have to use the actual return an investor's putting in their pocket. And if we look at that distribution component, DTLA, it changes based on the asset class. It's dividends for stocks.
And coupon payments for bonds.
Exactly.
Now, bonds have that unique feature you mentioned, the dirty price. Can you explain why MPT mandates using the dirty price, which is the clean price, plus accrued interest when we're calculating our portfolio weights?
Yeah, this is a really critical nuance for accuracy. Let's imagine you buy a bond for a clean price of, say, $1,000.
Okay.
If that bond pays coupons semi-annually and you buy it 3 months after the last payment, you actually owe the seller 3 months' worth of accrued interest. Let's say that's $20.
So my actual cash outlay is $1,020.
Precisely. Your actual capital outlay, the true fair market value of your position, is $1,020, the dirty price.
And if I calculated my portfolio weight based only on the $1,000 clean price, I'd be misrepresenting how much capital I've actually dedicated to that asset.
Exactly right. The portfolio weights, the $20 down, they have to sum to 1, representing 100% of your capital. By using the dirty price, MPT ensures that the capital base is accurate, which is essential before you even try to optimize the risk contribution of that asset.
So it's fundamentally a system designed for precision accounting before the math even kicks in.
That's a great way to put it.
Okay, so once we have those individual expected returns, calculating the portfolio's expected return is, well, that's the easy part.
Oh, that's just the weighted average. If 60% of your capital is an asset A with an expected return of 10% and 40% is an asset B with an expected return of 5%.
Your portfolio's expected return is just 60% of 10 plus 40% of 5, which is 8%. No complex interactions there.
Nope, simple.
The complexity and really the core of the whole theory is in the portfolio risk metrics, the variance. This is where we move from simple summation to relational dynamic.
Yes. For a 2-asset portfolio, the variance calculation suddenly involves 3 distinct terms. You have the variance of asset A, the variance of asset B weighted by their allocations, and then you have this crucial correlation component, 2WA, WB, sigma B, sigma.
And that coefficient, the correlation between asset A and asset B, that's the mathematical engine of diversification. It's the entire reason MPT exists.
And when you scale that up to a real portfolio of, say, none at all assets, that simple 3-term formula just explodes. The risk is determined by a vast matrix calculation.
Right.
You still have the non-dollar individual variance terms, but they are absolutely dwarfed by the complexity of the non-dollar inner to pairwise covariances.
Yeah.
If you have 100 assets, that's, 4,950 covariance terms you have to calculate.
So a portfolio's risk is exponentially more about the relationships between the assets than the risks of the assets themselves.
That's it. It transforms risk management from a study of singular data points into a complex network analysis.
The optimization process is then inherently about finding the optimal weights, the $2 that minimize the collective impact of that whole covariance matrix, not just minimizing the individual volatilities.
And that is what unlocks the free lunch.
The free lunch. I mean, given that every investment book warns there's no such thing, how can MPT confidently promise that diversification is fundamentally a risk-free benefit?
It's a free lunch because the mathematical proof for risk reduction holds true without you having to sacrifice any expected return.
Okay.
The diversification principle states that an investor reduces portfolio risk, the sigma muth, by combining instruments that are not perfectly positively correlated. As long as that correlation coefficient is less than 1, you benefit.
The sources really highlight that in a diversified portfolio, the variance relies more on the covariance than on the individual asset variances. Why does covariance dominate the risk equation in practice?
Because covariance is the only component you can actually control through selection. You can't change the intrinsic volatility, the sigma per node of an asset. If you buy a high-tech stock, it's volatile, period.
You can't change its nature.
Right, but you can choose a second asset whose movements tend to offset the first one. By selecting assets with low or negative correlation, you are actively manipulating that covariance term to neutralize volatility that would otherwise exist in your portfolio.
Let's break down the 3 correlation scenarios the sources detail, starting with the one that gives you 0 diversification benefit.
That's the benchmark for failure. Perfect positive correlation.
So everything moves in lockstep.
Perfect lockstep. Every time asset A jumps 2%, asset B jumps 2%. Mathematically, your risk reduction is 0. The portfolio standard deviation, sigma p, is simply the weighted average of the individual volatilities. You gain no safety from mixing them.
So owning, say, Exxon and Chevron might offer a tiny bit of risk reduction, but owning 2 ETFs that track the exact same index offers none.
Precisely. You've effectively just created a pseudo-single asset.
Okay, so now let's jump to the other extreme, the theoretical ideal, which proves the concept. 0 correlation to it.
Right. If the correlation is 0, that massive covariance term in the portfolio variance equation just disappears.
It vanishes entirely.
It does. And this allows for the maximum elimination of what we call idiosyncratic risk. The formula simplifies, and the mathematical proof by Markowitz showed that as the number of completely uncorrelated assets, that's node all approaches infinity, the portfolio variance approaches 0.
Wow.
This is the theoretical definition of eliminating all non-market risk. The idiosyncratic risk is just diversified away.
That's amazing. So in theory, if I could find infinite investment opportunities that were completely unrelated, like the price of copper in Chile, the rental rate of property in Berlin, and the revenue of a single tech startup in Singapore, I could approach a riskless return.
You could, theoretically. But the reality is the third scenario, partial correlation. $0 roll one.
This is where we all live.
This is the real world. Almost all assets have some correlation because they're all influenced by the same macroeconomic factors, the same systematic risk.
And yet this partial correlation is still the source of that free lunch.
Because as long as 1 is less than 1, even if it's 0.9, the resulting portfolio standard deviation will always be lower than the simple weighted average of the individual standard deviations.
And that difference is the benefit.
That difference is the diversification benefit. You get the desired expected return, but the volatility is less than what you would intuitively calculate just by averaging the component parts.
So it's the difference between investing in 2 things that are highly related, like 2 airline stocks, versus investing in 1 airline and, say, a utilities company.
Exactly. Even in a recession, the utility company might be relatively stable while the airline crashes, and that dampens the total shock to your portfolio. The key is that the volatility of the combo is lower because their peaks and troughs just don't align perfectly. It's the interaction that generates the value.
Okay, so this mathematical heavy lifting with the covariance matrix, it leads directly to this beautiful visualization that really changed financial decision-making forever. Let's talk about mapping the risk-return space and identifying the efficient frontier.
The risk-return space is basically our investment map. We plot expected return on a vertical axis and risk or standard deviation on the horizontal axis.
Right.
And every possible combination of risky assets, defined by minimizing the variance for a specific target return, generates a unique point on that map.
And when you plot all of these possible portfolios, they form this curved boundary, which is often called the Markowitz Bullet.
Correct. The boundary of this region is defined by solving a constrained quadratic optimization problem. Minimize the portfolio variance, sigma 22, subject to achieving a specified minimum expected return, (RAP dollars). And the result is this hyperbolic shape.
And the upper part of that hyperbolic boundary is what we call the efficient frontier. Why is it called efficient, and what does that imply for all the portfolios that lie below it?
A portfolio on that frontier is optimally balanced. If you are sitting on the frontier, you've achieved the lowest possible risk for that level of expected return.
Or looking at it the other way,
The maximum possible return for that level of risk. Any portfolio that plots below the frontier is suboptimal. It's inefficient. It means you are taking on more risk than you need to for that return.
you're getting ripped off, essentially. The theory is telling you, hey, you could move laterally to the left, reduce your volatility, and keep the exact same return.
Precisely. You should either adjust your allocation to reduce risk or adjust it to increase return until you land back on that frontier. The frontier is the standard of excellence.
And there's one specific point on that boundary that is mathematically unique, the vertex of the hyperbola. That's the Global Minimum Variance Portfolio, or GMVP.
The GMVP represents the portfolio with the absolute lowest possible risk you can achieve using the available risky assets, regardless of its expected return. It's the safest blend possible.
What's so fascinating about the GMVP is that it often involves some pretty non-intuitive allocations, right?
Yes. For a long-only investor, the GMVP might seem surprisingly concentrated. But in a full MPT model that allows for short selling, achieving the theoretical GMVP often requires you to short assets that have high individual volatility and high positive correlation with other assets.
You short them because their main contribution to the portfolio is just unwanted covariance.
Exactly. The GMVP is a mathematically determined point of maximum safety, and sometimes achieving that means taking on these strange, counterintuitive negative weights.
Okay, that brings us to a massive simplification for the investor, assuming this frontier has already been defined. The Two Mutual Fund Theorem, also called the separation theorem.
This is a fundamental result. It says that once the complex optimization is done, once that frontier is all mapped out, you only need two distinct, efficient portfolios, let's call them P-1 or P-2s, to create any other portfolio on that entire efficient frontier.
So an investor doesn't need to rebuild the entire covariance matrix for 100 stocks?
No.
They just need to find the right combination of two pre-optimized funds.
Exactly. If PP1 and PT2ers are efficient, your target portfolio, P-target, is just a linear mix. Alpha P1 plus 1 alpha P22. Those two funds span the entire frontier. This is immensely practical for large asset managers. They can provide these two funds and pass the complex work onto the investor in a simplified form. Just choose your preferred blend, alpha.
So that weighting factor, alpha, determines your position. If I want a standard long-only position between P-tau and P-tau dollars, alpha dollars is between 0 and 1.
Right.
But the theorem also explains how leverage and short selling work in this space.
It does. If you want a portfolio that sits outside the segment defined by P dollars and 2 tidal dollars, you need weights that fall outside that 0 to 1 range. If alpha is greater than 1, you're essentially shorting portfolio P dollars, giving it a negative weight, and using those proceeds to increase your investment in P-1 to more than 100% of your capital.
So that's how MPT mathematically incorporates leverage.
It is. And conversely, an alpha of less than 0 means shorting P$1 and leveraging into 2 tests 2. The math finds the optimal combination, even if it involves borrowing or shorting.
So the Two Mutual Fund Theorem simplifies the world of risky assets, but MTT takes one more giant step toward elegance by introducing a hypothetical, truly risk-free asset, $4.
This step is crucial. It's absolutely crucial because it allows us to optimize the entire investment universe, not just the risky subset. The risk-free asset is defined theoretically as paying a deterministic rate. It has 0 variance and, critically, 0 correlation with any risky asset.
In the real world, what's our best proxy for that? I mean, it's not perfect, but...
Typically, it's short-term government securities, like treasury bills. Now, they do carry marginal counterparty risks. The government could theoretically default an inflation risk, but their volatility over a short horizon is negligible. They're the closest we can get to a guaranteed return.
And when we combine this zero-risk asset, four-aft wall, with the curve of the Markowitz bullet, the entire geometry of investment opportunity just transforms. What happens to the efficient frontier?
It ceases to be a curve. It becomes a straight line, which we call the capital allocation line, or CAL.
A straight line.
This line represents the new, superior set of investment choices because you can now combine the risk-free asset with any risky portfolio.
So the CAL is a straight line drawn from the 3L4 intercept on the vertical axis, and it has to be tangent to the Markowitz bullet. Why is tangency the critical condition here?
Because the slope of that line represents the Sharpe's ratio.
Right, the reward to risk ratio.
The ratio of excess return that's returned above $4 to the risk, which is standard deviation. A straight line that is tangent to the curve has the highest possible slope. Therefore, the point where the CAL touches the risky asset bullet is the risky tangency portfolio, which is the portfolio of risky assets with the highest attainable Sharpe ratio. It offers the maximum reward for the risk you're taking.
Okay, let's map out the line itself. The vertical intercept is 100% in the risk-free asset, $3. The tangency point, $, is 100% invested in the risky tangency portfolio. So how do we interpret the space between those 2 points?
The segment between $3 and $, represents lending portfolios. An investor who is moderately risk-averse will hold a blend, say, 70% in pillars and 30% in one-of-I. They are, in effect, lending money at the risk-free rate.
They accept less risk than portfolio dollars offers, and so they get a lower expected return.
Exactly.
And for the aggressive investor who wants to move beyond portfolio dollars,
They move along the CAL beyond the tangency point. This represents borrowing portfolios. To get returns higher than Teller, the investor has to leverage Teller by shorting the risk-free asset or, in practical terms, borrowing money at the rate Friar learns and investing those borrowed funds plus their original capital entirely into the risky portfolio dollars.
and since the CAL is a straight line, the increase in expected return is perfectly linear with the increase in risk.
It is. This elegance leads directly to the one-fund theorem.
The ultimate simplification.
It really is. The theorem states that all investors can achieve their optimal risk-return profile using only the risk-free asset and that single, globally optimal risky fund, the tangency portfolio, 10 of them.
So regardless of your personal risk tolerance, the math says you should hold pausers.
You should hold pollers. Your risk appetite just determines the blend, how much margin you lend or borrow relative to your holding of dollars.
Now, the sources mention a technical caveat. The possibility of the tangency portfolio escaping to infinity. What does that mean for the model's validity?
It's a point where the model can fail. The tangency portfolio only exists if the risk-free rate is less than the return of the global minimum variance portfolio to a main VP.
Okay.
If free dollars were to somehow become extremely high, higher than the GMVP, the CAL would become parallel to the hyperbolous asymptote. In that theoretical scenario, the model suggests the optimal portfolio would diverge, requiring infinite shorting of some assets and infinite longing of others.
So if the return on risk-free T-bills is somehow higher than the safest possible combination of stocks, the model breaks down because it implies an obvious infinite arbitrage opportunity.
Exactly. It acts as a necessary theoretical check on the inputs. It forces us to confirm that the inputs are economically sound before the optimization can give us a meaningful result.
Okay, so this entire framework, MPT, the efficient frontier, the CAL, it's all the setup for understanding how assets must be priced in an efficient market. If all rational investors are following the CAL and holding that single optimal risky fund, pi dollars, what happens when the market reaches equilibrium?
In a state of market equilibrium, everyone is holding the risky assets in identical proportions, and those proportions are defined by the tangency portfolio.
Right.
Since the aggregated demand from all investors matches the available supply of all assets in the market, the tangency portfolio becomes the market portfolio. The single most efficient risky portfolio is, in fact, the market itself.
And this foundational link between MPT and the market portfolio is what gives us the capital asset pricing model, or CAPM. But before we get to the formula, we have to understand the core insight about risk compensation, which hinges on risk decomposition.
Yes. The total risk of any individual security has to be broken down into two components, and the market only compensates you for one of them. First, there's specific risk.
Idiosyncratic risk, unique risk, diversifiable risk. That's the risk tied to the single company, right? The CEO resigns, a product fails.
Correct. The factory burns down. Because these events are unique to the company and uncorrelated with the broader economy, they tend to cancel each other out when you combine them with thousands of other assets in a large portfolio. MPT proves this risk is eliminated through diversification.
And the second component is the one you can't get rid of.
That's systematic risk, market risk, non-diversifiable risk. This risk is driven by universal macroeconomic forces: inflation, war, interest rate changes, recession fears. Because it affects all assets at the same time, you cannot diversify it away.
So the core principle of compensation that drives CAPM has to be this. If I can eliminate specific risk for free by simply diversifying, then market has no incentive to pay me a premium for bearing it.
Absolutely. The market is rational and competitive. Therefore, the market only provides a risk premium for bearing systematic risk,
And so an asset's expected return isn't determined by its total variance.
but only by its measure of sensitivity to overall market movements.
And that sensitivity measure is the now famous factor, beta.
Beta is the quantitative realization of systematic risk. It's the asset's sensitivity relative to the market. Mathematically, it's calculated as the ratio of the asset's covariance with the market, that's sigma I, to the market's own variance, sigma m into 2.
So a beta of 1 means the asset moves in line with the market. A beta of 1.5 means that if the market moves up 10%, the asset is expected to move up 15%.
And if the market falls 10%, the asset is expected to fall 15%. It's a measure of leverage to systematic movement.
And that beta factor is what determines the asset's theoretical required return, which is plotted on the security market line, or SML.
Yes, and the SML states that the relationship between systematic risk beta and expected return must be linear. If two assets have the same beta, they must offer the same expected return, regardless of how much individual diversifiable risk they carry.
Okay, let's define the ultimate quantitative realization of this concept,
Yeah.
the CAPM equation itself.
The formula for the theoretical required expected return, ERE, is ERE equal RF plus beta, ERE RMRF.
So it breaks the required return into two components.
It does. The time value of money, which is the risk-free rate, or risk-free way, and then the compensation for systematic risk. The term ERMRFE is the market risk premium, the extra return the market offers over the risk-free rate.
The logic here is so powerful, it's really worth walking through the logical derivation even without showing all the calculus. Why must this formula hold true in equilibrium?
It all rests on that foundational assumption of MPT, that the market is efficient and there can be no uncompensated risk. So imagine we have two assets, A and B. If we were to add a marginal amount of asset A to the market portfolio, more $1, we would gain a marginal expected return and take on a marginal amount of risk.
And since the market is in equilibrium, the ratio of that marginal expected return to the marginal risk has to be the same for every single asset we consider adding.
Exactly. If the marginal reward to risk ratio for asset A were higher than that for asset B, investors would flock to asset A, driving its price up and its expected return down until the ratio is equalized.
So in equilibrium, the marginal reward to risk ratio for any asset must equal the reward to risk ratio of the market portfolio itself.
That's the Trainer ratio equality.
Mm.
And by using the definitions of return, risk, and covariance, and setting the marginal contribution of an asset equal to the marginal contribution of the market, the algebraic rearrangement just forces the equation into the CAPM format. It's a self-consistent proof that the required compensation is entirely determined by beta.
It's an intellectual powerhouse. So how is this applied in practice? If I calculate this required return, what do I do with it?
You use it for valuation. The required return, E and dry, acts as the discount rate to calculate an asset's intrinsic present value, or value dollars, based on its expected future cash flows.
And if the calculated value is higher than the current market price, the asset is theoretically undervalued.
And it should offer a positive abnormal return.
And that abnormal return leads us to the metric that defines the success of active managers, alpha.
Alpha is the measure of performance above and beyond what the systematic risk, or beta, of the portfolio should have generated. Statistically, we estimate CAPM using a regression known as the security characteristic line, or SCL, which plots the asset's excess return against the market's excess return. Alpha is the intercept of this regression.
In a world where CAPM holds perfectly, alpha should be 0, right?
Precisely. If alpha is positive, the manager has generated excess return through superior security selection, or timing, in other words, successfully navigating the diversifiable, idiosyncratic risk portion. And that is the active manager's entire goal. To prove they are skilled enough to generate an alpha greater than 0 consistently.
MPT is a beautiful, mathematically sound theory that earned the Nobel Prize, and yet it is also, arguably, the most criticized concept in modern finance. Let's tackle the fundamental flaws, starting with the biggest practical weakness, estimation.
Yeah, this is a big one. MPT is built entirely on expected values, future returns, future volatility, future correlations. But those inputs are, by definition, unobservable.
We can't see the future.
Right. So in practice, we're forced to substitute historical data as proxies for these expectations.
And the fundamental problem with using history to predict the future is that the future often contains circumstances that history simply hasn't recorded yet.
Yeah.
Exactly. For MPT optimization to work optimally, you need an accurate, forward-looking covariance matrix. But the matrix you calculate today is based on, say, a last 10 years of data. That data knows nothing about the next major technological disruption, or a sudden pandemic, or a rapid geopolitical regime change.
So MPT is intrinsically backward-looking, but its results are used for forward-looking decisions.
Yes, and that's a huge disconnect.
A second, much deeper mathematical criticism targets the bedrock assumption that allows the calculations to be so elegant in the first place. The Gaussian assumption.
Right. MPT assumes that asset returns follow a Gaussian or normal distribution, the classic bell curve. This is what allows standard deviation to be a complete measure of risk.
But critics, including Nobel laureate Eugene Fama and the brilliant fractal mathematician Benoit Mandelbrot, show this is just inadequate for real-world finance.
It really is.
So what's the reality of financial returns compared to that idealized bell curve?
Real-world returns are characterized by elliptokurtosis. They have very high peaks and, critically, fat tails.
Which means that small changes happen frequently. That's the high peak. But extreme events, those massive rapid market crashes or booms, happen far more frequently than the normal distribution predicts. The Gaussian curve severely underestimates the probability of these outlier events.
So MPT models look at historical data, they calculate the standard deviation, and then they tell an investor that a 3 standard deviation event, a massive crisis, should happen maybe once every 1,000 years.
And then it happens 3 times in a decade.
Right.
Nassim Taleb famously criticized this in the wake of the 2008 crisis. He argued that MPT models, based on the Gaussian assumption, were essentially hot air. He said the models were beautifully platonic, but fundamentally disconnected from reality because they failed to properly account for the non-normal frequency of these large market movements, what he termed black swans.
And the failure isn't just in calculating the probability of loss, but in calculating the correlation spike. What happens to that beautiful diversification benefit during a crisis?
That's the most devastating practical failure. Diversification works when DROAS is less than 1. But during a systemic crisis, like the one that struck LTCM in 1998 or the global financial crisis in 2008, the one thing that NPT optimization relies on completely collapses.
What happens?
Correlation spikes to 1. All assets start moving in lockstep, usually downward.
So the diversification benefit vanishes at the exact moment you need it most.
Absolutely. The model tells you the assets are poorly correlated, but in the specific structural scenario of a liquidity crunch or a mass deleveraging, all bets are off, and that correlation matrix becomes meaningless.
Let's talk about the distinction between probabilistic versus structural risk. This is a major philosophical gap between MPT and traditional engineering risk management.
MPT is purely probabilistic. It deals only with numerical likelihoods derived from historical frequency. It can tell you there's a 5% chance of a 10% loss, but it says nothing about the underlying causality or interconnectedness.
Whereas a nuclear engineer using a PRA model looks at system relationships. If component A fails, does it overload component B? They're modeling the structure of the failure.
NPT completely lacks that structural model. It cannot compute the odds of a novel system-level event, say, a sudden collapse in confidence driven by social media that has no historical precedent, because there's no historical data to feed the variance calculation. The model is blind to novel structural risks and feedback loops.
And finally, there's a key behavioral flaw: the symmetry of variance and loss aversion.
Yeah, variance is mathematically symmetrical. It treats a 10% positive surprise, good volatility, as equally risky as a 10% negative surprise, which is bad volatility.
But we know from Kahneman and Tversky about loss aversion. The pain of a loss is psychologically 2 to 2.5 times greater than the pleasure of an equivalent gain.
And since MPT treats gains and losses symmetrically, its measure of risk often doesn't align with an investor's true psychological preference. Investors care deeply about downside risk, which MPT just bundles together with upside potential.
And this disconnect led to other theories, right?
It did. It led to the development of postmodern portfolio theory, or PMPT, which uses asymmetric risk measures like semivariance or downside deviation. It focuses solely on volatility below a target return, trying to capture that true sense of loss aversion.
And we can't forget the traditional critiques from, say, value investors, those who focus on intrinsic business value rather than statistical inputs.
Contrarian investors like Sir John Templeton often express profound skepticism about MPT's reliance on historical data. They argue that focusing on unreliable and irrelevant statistical inputs like historical volatility just distracts from fundamental analysis. For a value investor, risk isn't about volatility, it's about paying too much for an asset or the risk of permanent capital loss, which MPT doesn't explicitly model at all.
So MPT may have its flaws, but the underlying concepts, optimization, efficiency, measuring return against volatility, are so general that they've proven useful in some really surprising domains, completely outside of stocks and bonds. Let's look at some of these real-world use cases.
A very common application, especially in corporate finance, is optimizing project portfolios. A large pharmaceutical company, for instance, has a portfolio of new drug development projects. Each project has an expected return, its profitability, and a defined risk, the chance of failure.
And the optimization goal is the same. Maximize the expected return of the entire slate of projects for a given level of aggregate risk. But projects are fundamentally different from liquid financial assets. You mentioned lumpiness.
That is the main caveat. Financial assets are continuously divisible. You buy 1 share or 1,000 shares. Projects are often lumpy. They're all or nothing. You either fund the new factory 100% committed, or you don't, 0%.
Which makes the modeling much more complex.
Significantly more complex than standard MPT optimization, which assumes continuous divisibility.
And the illiquidity factor is huge, too.
Absolutely. If a stock starts to fail, you can sell it instantly and minimize your losses. If you abandon a half-complete drug trial, the sunk cost is likely a 100% loss of capital.
So how do you measure risk?
Well, since projects don't have historical variances based on daily price movements, the risk is typically expressed in more subjective terms, like probability of failing to achieve cost of capital, or chance of losing more than half the investment. But the conceptual structure of finding the efficient frontier for projects remains valid.
Okay, where else have these quantitative optimization ideas cropped up?
Well, in the 1970s, MPT concepts were adopted in regional science and economics. Researchers started modeling the composition of a regional labor force or an industry mix using these portfolio theoretic methods.
So they're trying to optimize the regional economy's portfolio of different industries to achieve stable growth.
Stable growth while minimizing cyclical variability.
That's fascinating. Treating a city's industrial base like a stock portfolio, trying to make sure that when the manufacturing sector is down, the service sector is up.
Exactly. It leverages the covariance concept, trying to ensure that different segments of the economy are not perfectly correlated, which provides economic stability. Even more abstractly, MPT has been applied to social psychology to model the self-concept.
The self-concept. How does your sense of self become a portfolio?
Researchers theorize that the attributes, identities, and roles that define a person, parent, employee, athlete, friend act as psychological assets. The strength and independence of these assets determine your psychological stability.
So if your entire sense of self-esteem relies only on one domain, say your career, and you lose your job, your whole psychological portfolio suffers massive volatility.
That's the idea. Diversifying your identity is the psychological equivalent of diversification, reducing the portfolio's standard deviation. A well-diversified self-concept with low covariance between roles provides a kind of built-in psychological insurance against failure in any single domain.
That's a remarkable generalization of the core math.
It is. And finally, NPT principles are even used in information retrieval. When search engines rank documents, they're not just looking for maximum relevance, which you can think of as expected return.
They're also trying to minimize what?
Minimize the uncertainty or ambiguity of the ranked list, the risk. The goal is to maximize the overall relevance of the set of retrieved documents while minimizing the chance that the user clicks on a series of irrelevant links. Documents become assets in an information portfolio. Hashtag tag outro.
This deep dive really shows that modern portfolio theory is an undeniable intellectual achievement. It formalized the free lunch of diversification, it established the efficient frontier as the mathematically optimal boundary, and it fundamentally proved that the market only compensates investors for bearing systematic risk, which is measured by beta.
And despite its reliance on statistical proxies and that often flawed Gaussian assumption, which, led to it underestimating the probability of fat-tailed black swan events, MPT remains the fundamental building block for asset pricing and risk management globally. It gives you the necessary language and the map to understand how risk compensation works.
I think the ultimate lesson MPT provides is that risk is not inherent to what you own, but rather about what you own relative to everything else. So given the criticisms that MPT failed to predict major structural shifts and systemic crises precisely because it lacks a structural model, here is our final provocative thought for you to chew on. If the next major risk to our global portfolios isn't just financial volatility, but rather non-financial, systemic structures like rapid climate shifts, irreversible geopolitical fragmentation, or uncontrolled technological displacement events that have zero historical variance data to feed into the traditional MPT model, how should we redefine our concept of beta to account for the systematic risks that are currently invisible to the mathematical models of 1952? Think about that as you consider how much weight you put on the past when predicting the future.